What is mortgage insurance? How does it work? If you are taking in a mortgage and you need to know the right fit insurance for your mortgage, how do you define that one? Would you totally rely on online quotations or some advisors, but you still want to make sure that you are not being ripped off on these kind of insurance? Let's talk about this, how you can make sure that you are taking a right fit insurance for your mortgage today. Let's understand in simple words, how does it work, the mortgage insurance? By the way, in UAE, 100% of the mortgages are compulsory to be insured under the mortgage insurance. Simple. How does it work? Assume this is Leena and who has taken a mortgage of a property for 10 million and a bank is giving me this amount and they ask me to insure it. Why? Because if I'm not there tomorrow, all my borrowings from the bank, somebody has to look after. If I have not insured my mortgage or if I have not insured my borrowings, irrelevant if it is sometime you are taking from the developer, ensure that you take this insurance as long as you have a liability towards it. So comes back to it, if I die or when I die, my remaining borrowing will be taken care from the insurance money which will come to it. It will go to the bank, and my property which I actually made for my family will be reserved for them. Nobody is going to touch that. No developer coming to it. That is where the mortgage insurance comes in the picture. That is why it is mandatory in the UAE to every mortgage to be insured. But on the side scenario, I would say that even if you're not taking a mortgage and you are on a developer plan, you have taken a property where you're going to make a payment for next 5 year or 10 year, it's good to insure it because this is thing which we do it for our family. We don't do it to go into default and give this property back to the developer. Coming to the scenario, how do you make sure this is a right fit mortgage insurance and you trust that thing, that how it's working? So there are three main elements which I'll share with you, and so then you can make the right decision by yourself. Number one, the cover. There are two types of main insurances usually being seen in scenarios like mortgage insurance. One is a level term, another one is a decreasing term. So I'll give you an example for both. How does it work? Imagine I have taken a loan for 10 million and this is the same cover I need it for next 10 years. My loan is for 10 years. I want to make sure next 10 years my cover remain the same, 10 million. That's called level term. Number two type is the decreasing term. So my loan is for 10 years, but every year I'm paying, so it comes down by 100,000. So my loan gets down every year. So as my life cover on that comes down every year. That's why it is called decreasing term. So this is the cover difference between these two types. And let's coming to the cost, which is the number two item. What is the cost in level term versus in decreasing term? Yes, level term costs me slightly higher than the decreasing term because my cover is same for throughout the year. So insurance company has a much bigger risk on my life cover throughout the period, like a 10 million as mentioned. Or if it is decreasing, then of course insurance companies have a lesser risk. So the cost on item number two type insurance, which is a decreasing terms, comes lower. Item number three, which you need to know about these two insurances when you take a right fit insurance for you, flexibility. Yes, it is important to have a flexibility because I have seen a lot of people who change their mortgage from A bank to B bank, B to C bank. Every 2 to 3 years they see the promotion somewhere and they keep changing the mortgage from A to B bank. Or if they don't have any other insurance on place, then this insurance works for them like a heaven. Yes, then it is serving the two purpose for them, life cover for family, also looking after the mortgages. The flexibility remain in that. So if you keep changing one to another bank, you can have a same policy going on just to change the assignment from A to B bank, and that you still have the cover going on. Sometimes people take a break or extend the cover, or sometimes they take a larger loan in between. If you have a fixed loan amount, 10 million, you can always play in this amount figure. So this gives you a larger flexibility area. Whereas a decreasing term, you are very less likely to have a flexibility because your loan is coming down, so your cover coming down. So if you change the bank and your cover should be only as much as left, as much your loan supposed to be, if you increase the loan amount, this will not serve your purpose. At the time, you probably need to take another policy to serve it. As I talk about that, these three things you make sure you look into your mortgage insurance. I have seen people get ripped off by giving a larger policies which has an investment, all this and that, and that costs the client very expensive. Sometimes clients are in the pressure that time when they are just dealing with the bank and they want to get their mortgage released very quickly, so they just go with something as soon as comes to them. But make sure the loan is attached to your life insurance. It's only level term or decreasing term, which is the best way to go for it when it comes to mortgage insurance. Yes, if you're thinking a different way and you want some investment included in that, then you can go for a third type of insurance, which is whole of life, but it is way more expensive. Term insurance, decreasing term insurance, let's say if I number them and score them between 3, decreasing term, number 1 being chosen by clients because this is the most cheapest, or I would say less expensive. Then it comes to term insurance, of course the second most less expensive, and then the whole of life, which is including the unit linked plan, investment. That's not what I would advise anybody to go with that if they are only purely looking for mortgage insurance. Hope this information has empowered you to ensure the next time when you're going for a mortgage insurance, you know how to choose the right fit mortgage insurance for you.